Total revenue for Biogen, Q2 2026, $2.736 billion.
Right.
That is up 3% year over year. But imagine reading an earnings report where management raises your expected underlying profits by 60 cents for the year.
Oh, only to read the very next sentence where they slash your reported guidance by nearly $4.
Exactly. That is the exact whiplash happening in this quarter's numbers. I mean, GAAP-diluted EPS is sitting at just 66 cents.
But then non-GAAP diluted EPS is a massive $3.60. It's a huge gap.
It really is. And, looking at the full year, management bumped up their underlying guidance to a range of $15.85 to $16.85.
Yeah, yet their reported guidance just fell off a cliff.
Slash entirely down to between $12 and $13.
We are essentially looking at the definition of a split-screen financial reality here.
Yeah.
The operational side of the business,
Yeah.
the actual selling of drugs and generating of cash, that is accelerating in one direction.
While the reported accounting reality is just being dragged heavily in the completely opposite direction.
Yeah.
So for you, the retail investor trying to parse out whether this company is actually healthy, it looks like a glaring contradiction.
Oh, absolutely, because a company doesn't simply lose $4 of expected earnings per share overnight without some massive catalyst.
Right. So we need to cut through the accounting noise that is muddying up these headlines today. The underlying business improved, but the reported numbers took a massive hit.
Right, and the catalyst driving that entire discrepancy is the recent acquisition of Apellis.
Which closed back in May, right, May of 2026.
May 2026, exactly. And this fundamentally rewired Biogen's income statement for the year.
How so?
Well, they didn't just, license a molecule in a lab. They bought a fully operational commercial engine to bolt onto their specialized immunology segment.
Right, they brought in 2 major commercial stage drugs.
Yeah, and absorbing a massive asset like that forces you to take on heavy, immediate financial burdens, just to secure the long-term cash flow.
And we are already seeing that cash flow materialize, to be fair. I mean, SYFOVRE pulled in $97.4 million in U.S. revenue this quarter.
Yeah.
And Empaveli contributed another $30.4 million. So they were putting points on the board right out of the gate.
For sure. SYFOVRE in particular is the heavy hitter there.
Because it treats geographic atrophy, right?
Yeah, which is a devastating, highly progressive form of age-related macular degeneration.
Right.
Essentially, cells in a specific region of the retina just simply waste away, and it leads to irreversible blindness.
Which is a massive unmet need in our aging demographic right now.
Exactly. So having a therapy that can actually slow that progression creates a highly sticky recurring revenue stream for Biogen.
But acquiring that stream requires upfront capital and really complex integration.
It does. I mean, Biogen expects about 85 cents of dilution to their non-GAAP EPS in 2026 solely from financing this Apellis deal.
Wow. Let's break down the mechanics of that 85-cent hit for a second.
Sure.
Because when a company pulls off an acquisition, the cash to buy the target company doesn't just, materialize out of thin air.
Right. You're either draining your own savings account or you're putting it on a corporate credit card.
And Biogen is getting squeezed on both ends of that equation.
Yeah, management actually laid out that their full year other income and expense line is going to be a net expense of $250 million to $275 million.
So by using their cash reserves to buy Apellis, they instantly lose the interest income that cash was just passively generating in the bank.
Exactly. And then by taking on new debt to finance the rest of it, they trigger new heavy interest expenses.
Okay, so the financing costs explain the 85 cents.
Right.
But the much larger crater in the reported guidance, the reason we are dropping from roughly $16 down to $12 is a mandatory accounting mechanism, right?
Yes. It's known as acquired IPR&D, along with milestone charges.
IPR&D. So in-process research and development.
It's exactly. In the pharmaceutical sector, buying a company means you are acquiring their current active clinical trials and their lab work.
You're buying their future potential.
Yeah, which sounds like an asset.
Right, it does.
But accounting standards force companies to treat the purchase of those unproven ongoing clinical trials as a massive immediate expense rather than a capitalized asset.
Ah, okay. So it's a conservative rule designed to prevent companies from, inflating their balance sheets with drugs that might just fail in phase 3 trials anyway.
Exactly. And the financial impact of that specific rule is severe here. For Biogen, the hit from those acquired IPR&D and milestone charges is roughly $2 per share.
Wow.
Yes, when you combine the 85 cents of financing dilution with the $2 of upfront R&D charges, you arrive at that brutal downward revision in the reporting guidance.
So it's basically the corporate equivalent of buying a dilapidated apartment building in a prime neighborhood.
That's a great way to put it, yeah.
The upfront mortgage costs and the immediate mandatory renovations just completely destroy your cash flow for the current year.
Right.
And that is the $12 to $13 reported guidance. You are bleeding cash on paper today, but you're doing it because the rental income you project for next year makes the math undeniably attractive.
And management is communicating that exact timeline to the market right now.
Yeah, they are projecting the Apellis deal to be fully accretive to non-GAAP EPS by 2027.
So that short-term accounting pain transitions into actual bottom-line growth
Yeah.
in a very specific window.
Right, but they are anchoring that timeline to a promise of realizing at least $250 million in run rate synergies as they exit 2027.
Yes, they are.
And I have to challenge the reality of that $250 million figure.
Oh, really?
Yeah, I mean, run rate synergies is like the ultimate corporate security blanket.
Well, sure.
Whenever an executive team needs to justify a wildly expensive acquisition that dilutes shareholder value in the near term, they just sort of wave their hands and promise millions in magical synergies.
I hear you.
Getting $250 million in actual savings out of two colliding corporate cultures is rarely that clean. So is this a tangible target, or are they just trying to soothe retail investors who are staring at a massive earnings drop?
Well, skepticism around synergy targets is usually totally warranted, but pharmaceutical mergers actually offer incredibly straightforward pathways to cost cutting.
Okay, how so?
When Biogen absorbs Apellis, they do not need two separate human resources departments. They don't need duplicate IT infrastructures or redundant compliance teams or, overlapping supply chain managers.
Right, the administrative overlap is huge.
Exactly. And more importantly, Biogen is already executing an internal optimization strategy they call the Fit for Growth program.
Oh, right.
So they are actively stripping out excess overhead across their entire operation anyway.
So funneling Apellis into an organization that is already aggressively streamlining makes that $250 million highly visible.
Yes. They are firing the redundancies, so the pure revenue from SYOVRE just flows directly to the bottom line without all that administrative bloat.
That makes sense. And honestly, the accounting whiplash of the Apellis deal is ultimately just a symptom of a much larger physical transformation happening inside the company.
Oh, absolutely.
Because the numbers we're looking at this quarter, they signal a permanent changing of the guard. Biogen is successfully decapitating its old core business and replacing it with a brand new one in real time.
The magnitude of this quarter's structural shift really cannot be overstated. I mean, we are watching a legacy pharmaceutical giant cross the ultimate threshold here.
The internal segmentation really tells the whole story. Biogen essentially divides its commercial identity into two buckets.
Right.
You have the legacy MS, or multiple sclerosis, portfolio, and then the newer growth portfolio.
And this quarter, the growth portfolio surged to $1.06 billion. That's a 24% increase year over year.
While in the exact same breath, the legacy MS portfolio collapsed to $767 million, which is a 14% drop.
Yeah. The new assets have officially, mathematically, overtaken the old assets.
Which is huge, considering for decades the name Biogen was entirely synonymous with multiple sclerosis.
It really was. Therapeutics like Tecfidera and Avonex, they built the modern iteration of this entire enterprise.
But the life cycle of a blockbuster drug is unforgiving.
It's brutal. Patents inevitably expire, and the moment exclusivity is lost, generic manufacturers just flood the market.
Because they don't have to recoup billions in research and development, so they can instantly slash prices to secure pharmacy placements.
Exactly. The original drug's pricing power just evaporates overnight, and it takes the revenue right along with it.
And management obviously knows this. They project the legacy MS decline to continue dropping by a mid-teen percentage for the entire year.
Right. And even the drugs that were meant to extend their dominance in MS are feeling the drag now.
Yeah, Vumerity hit $197 million this quarter, but that was actually down 7% year over year.
Though the report does clarify that this specific drop was tied to fluctuating inventory dynamics.
Meaning wholesalers were just altering how much stock they hold.
Exactly. And Vumerity is actually up 7% if you look at the first half of the year as a whole.
Okay, fair enough. But zooming out, the structural decay of the MS Foundation is permanent.
It is. And the existential threat hanging over investors for the past 5 years has been the pace of this exact transition.
Because a 14% decline on hundreds of millions of dollars in MS revenue is a massive hole to fill.
It's huge. The fear was always that the legacy cash cow would bleed out faster than the new pipeline could possibly scale up to replace it.
Which would plunge the company into a sustained period of shrinking revenues.
Right. But this quarter's massive $1.06 billion print from the growth portfolio definitively silences that fear.
Let's actually run the math on that sustainability for a second, because a 24% growth rate on $1 billion is spectacular, but it is fighting a really heavy gravitational pull from those decaying legacy drugs.
It is.
Yet total revenue actually increased by 3% year over year to $2.736 billion.
Right. So if the new drugs were only treading water, that total revenue figure would be deep in the red.
Exactly. Posting overall positive growth while your historical core business drops by 14% proves the growth portfolio is doing way more than just plugging holes.
It is actively expanding the top-line revenue of the entire company.
And that expansion is built on a highly diversified mix of therapeutics, right? Which insulates the company from future patent cliffs.
Yes. The rare disease segment is a prime example of that. It posted a 10.8% increase year over year.
With Spinraza acting as the anchor for that rare disease growth, it pulled in $401.9 million for the quarter.
Which is up 2%.
Right. And on the surface, a 2% bump sounds completely stagnant. But the underlying mechanics driving that retention are actually pretty fascinating.
They are. The earnings report notes this growth is heavily fueled by patient demand for a new high-dose regimen.
And that conversion is outpacing the company's global expectations, isn't it?
Yeah, it is. The mechanism behind a high-dose regimen is really a masterclass in pharmaceutical lifecycle management.
How so?
Well, Spinraza treats spinal muscular atrophy, and delivering this type of therapy often requires incredibly invasive procedures.
Like a lumbar puncture to inject the medication directly into the spinal fluid.
Right, exactly. So if a company can optimize the formulation to deliver a safely tolerated higher dose, they can fundamentally change the patient experience.
Oh, I see. It might mean extending the time between those painful administrations.
Yes, or achieving a deeper, more sustained clinical efficacy. And when you improve the physical reality for the patient that much, they do not switch to a competitor.
Wow, so that rapid global conversion to the high-dose regimen is essentially cementing Spinraza's market share.
Exactly. It turns it into a highly defensible foundational revenue stream.
Got it. Now, the other major player in the rare disease space is SKYCLARYS, which contributed a very strong $167.9 million.
Right.
But if we're looking under the hood of the growth portfolio, every retail investor is intensely focused on one specific asset.
Oh, absolutely. LEQMB.
LEQMB. This is their highly anticipated Alzheimer's treatment. And the total addressable market, the TAM, for Alzheimer's is almost unimaginably large.
It's staggering. It is arguably the most significant unmet medical crisis in the aging world right now.
So the sheer scale of the potential patient population makes LEQMBI the ultimate focal point for future valuations.
It does.
But let's look at the actual reality of the launch here. They reported $184 million in global in-market sales.
Yeah.
With $97 million of that coming from the U.S. That is a 15% year-over-year increase. But we need to be realistic about those numbers.
Sure.
When a company announces a breakthrough drug for Alzheimer's, retail investors expect to see billion-dollar revenues flooding in by the second quarter.
Sure.
$184 million globally feels incredibly light for a drug with this much hype. So, are we looking at a failed, stalled rollout, or is this just the required trajectory for a complex neurological biologic?
It's the latter. Comparing a novel neurological biologic to a traditional blockbuster pill fundamentally misunderstands how modern healthcare operates.
Okay, unpack that for us.
You don't just, write a prescription for IQMBI and pick it up at a local drive-through pharmacy.
Right.
Rolling out a therapy of this magnitude requires building an entirely new logistical infrastructure across the medical system.
Yeah.
Management explicitly calls this a multi-year registrational cycle.
A registrational cycle, which is essentially a sanitized corporate term for a massive on-the-ground logistical bottleneck.
Basically, yeah. To get a single patient on LEQMBI, they first have to recognize their cognitive decline and get a referral to a specialist.
Right.
The neurologist then has to confirm the presence of amyloid plaques,
which requires either a highly specialized PET scan or an invasive lumbar puncture.
Yes, both of which have massive wait times and capacity limits right now.
And even if they qualify through all that, the patient then needs to secure a slot at an outpatient infusion center for biweekly intravenous treatments.
Exactly. And because the drug carries severe risks of brain bleeding and swelling, known as ARIA, The patient has to be continually monitored with routine MRI scans.
You are describing the necessity of rewiring the operational flow of thousands of clinics and hospitals.
That's exactly what's happening.
Hmm.
The infrastructure simply did not exist to process Alzheimer's patients through that intense diagnostic and infusion pathway at scale.
So Biogen is effectively having to fund and build the charging station network before they can sell the electric vehicle.
That is a perfect analogy. So a 15% year-over-year increase to 184 million just demonstrates that this infrastructure is being methodically built.
And that clinics are slowly increasing their throughput.
Right. It is a slow, grinding ramp-up by design. It's focused on expanding capacity quarter after quarter rather than, an overnight explosion in sales.
But building out that massive physical infrastructure of infusion networks and diagnostic pathways for LEMBI, alongside integrating the Apellis acquisition, that does not happen for free.
Oh, definitely not.
The 24% revenue surge in the growth portfolio is exceptional, but that physical reality is exactly why the cost of operations side of this earnings report looks so bloated. The margins are taking a serious beating.
They really are. Cost of sales spiked dramatically this quarter.
Give us the numbers on that.
On a GAAP basis, it hit $777 million, which represents 28% of total revenue.
Wow.
Yeah, look back just 1 year, and that figure was sitting comfortably at 23%.
And even when you strip out the accounting noise and look at the non-GAAP numbers, cost of sales rose to $612 million, or 22% of revenue.
Right. The actual physical production, distribution, and integration of these new therapies are getting significantly more expensive relative to every dollar they bring in.
And the burn rate accelerates even further when you look at operating expenses.
The OpEx.
Yeah, the core research and development paired with selling, general, and administrative costs. OpEx hit a staggering $1.24 billion gap for the quarter.
It's massive.
And this is not a one-time anomaly. Management projected that for the second half of 2026, non-GAAP R&D and SG&A will run between $2.65 billion and $2.70 billion.
The ongoing integration of Apellis and the commercialization of the growth portfolio just demand that level of capital allocation.
Well, I'm going to play devil's advocate on this massive spend for a second.
Okay, let's hear it.
They are burning well over $1 billion in OpEx in a single quarter just to market and research the new portfolio.
Right.
Meanwhile, another segment of their business is actively bleeding out. Biosimilars revenue came in at $252.8 million.
Yeah, which continues a low double-digit percentage decline year over year.
Right. And biosimilars are essentially generic versions of complex biologic drugs, and the report actually cites volume decreases and unfavorable pricing from steep competition.
The biosimilar market is a brutal race to the bottom on price just to win contracts.
Exactly. So with biosimilars trapped in a pricing death spiral, the legacy MS business dropping 14%, and margins tightening on the cost of sales, how much runway does Biogen actually have before institutional investors start demanding aggressive cuts to that $1.2 billion OpEx budget?
It's a fair question. The tension between protecting near-term profitability and heavily funding future growth is arguably the hardest balance to strike in biotechnology. But cutting the SG&A or R&D budgets right now would be catastrophic to their long-term survival.
You think so?
Absolutely. That massive operating expense is a mandatory defensive moat during this vulnerable transition period.
I see what you mean. You cannot starve your future engines to artificially prop up the profit margins of your dying ones.
Exactly. If you slash the marketing and infrastructure budget today, you instantly stall the rollout of LB-MBA.
The infusion networks stop expanding, the diagnostic wait times freeze.
And you stall the launch momentum of SYOVRE right as you were trying to capture the geographic atrophy market.
Okay, so the spending is exorbitant, but it is highly targeted at the specific assets that will dictate Biogen's market cap in 2030.
Yes, and their runway to sustain this strategy is actually quite stable.
Because of the free cash flow.
Exactly. The underlying business generated $408 million in free cash flow this quarter alone.
That helps.
And they're still sitting on $1.3 billion in cash and cash equivalents. The financial architecture can support this heavy investment phase, provided the newly acquired assets continue to hit their growth metrics.
So the entire narrative of this earnings report really hinges on management's phrase, a multi-year registrational cycle.
It really does.
That is the reality for you analyzing this stock today. The legacy multiple sclerosis drugs that built the foundation of this company over the last 2 decades are officially in the rearview mirror.
Yeah, Biogen is functionally a brand new enterprise today, compared to what it was 5 years ago.
They have placed massive, highly expensive bets on the specialized immunology of Apellis and the complex neurological logistics of Alzheimer's.
And the pivot is succeeding mathematically. The growth portfolio has assumed command of the top line. But transitions of this magnitude require immense capital and structural patience.
Which means the dividing line for investors is entirely based on their time horizon.
Right. Are you willing to weather the ugly reported dilution, the IPRD charges, and the heavy operational spending of 2026?
In exchange for the promised synergies and clear bottom-line accretion projected for 2027 and beyond.
Exactly. That's the gamble.
And taking a step back from the ledger for a second, LEMBI's slow rollout presents a much larger, frankly alarming question about our future.
How so?
Well, if it takes this much upfront capital, massive dilution, and years of logistical gridlock just to establish the basic diagnostic and infusion infrastructure for a single Alzheimer's drug.
Yeah.
What exactly is going to happen to the global healthcare system when the next 5 breakthrough neurological therapeutics hit the market at the exact same time?
It's a huge problem.
Our current medical infrastructure is completely unprepared for the sheer volume of complex biologics coming down the pipeline. We have a lot of building left to do.
We really do.
Make sure you follow the show so you never miss our daily earnings coverage, keeping you ahead of the numbers and the narratives. See you next time.